If you've been trading crypto and your account keeps bleeding slowly or getting liquidated fast, this video might change the way you trade forever. Most retail traders don't lose because they are stupid. They lose because they are trading the wrong market for their psychology. And here's the uncomfortable truth. Crypto is built for volatility, but not for consistency. Today I'm going to show you how to trade Forex and gold on Bitget TradFi step by step, and more importantly, why this shift alone can dramatically reduce your risk if you know what you're doing. And stay with me because later in this video I'll show you a simple risk model that most beginners ignore, and that's exactly why they blow up their accounts. The real problem with crypto trading, let's be honest. Crypto moves 10%, 15%, even 30% in a single day. That sounds exciting. But excitement is expensive. High volatility means high emotional pressure. You hesitate, you FOMO, you revenge trade, and leverage makes everything worse. You think you need 50x or 100x to make real money. But what you really need is stability and controlled exposure. That's where Forex and gold come in. These are institutional markets. They are deep, liquid, and structured around macroeconomic flows, not hype cycles. And here's the key insight. When volatility is structured instead of chaotic, risk becomes manageable. That's what most traders never understand. What is Bitget TradFi? Now let's talk about Bitget TradFi. If you already use Bitget for crypto futures or spot, this will feel familiar. TradFi on Bitget allows you to trade traditional financial instruments like Forex pairs and gold using USDT as margin. That means you don't need a separate broker, no complicated funding process, and no dealing with multiple platforms. Everything stays inside your Bitget ecosystem. And that simplicity reduces friction. When friction goes down, execution improves. And when execution improves, your consistency improves. Before we go deeper into strategy, let me quickly explain how to get started because this part is important. You create a Bitget account using the link in the description. When you register, make sure you use referral code REBATE20. That code gives you 20% fee rebate on futures and spot trading and access to a welcome bonus up to $6,200. Depending on your activity, if you're going to trade anyway, you might as well reduce your fees from day one. Over time, fee reduction alone protects your capital more than you think. How to access Forex and gold on Bitget TradFi. Once your account is ready and verified, go to the TradFi section inside Futures. You'll create your TradFi trading account and transfer USDT from your main wallet into that account. You don't need thousands of dollars. Even a small starting capital, like 50 to 200 USDT, is enough to learn properly if you manage risk correctly. And that's where most people mess up. They think small capital means high leverage. It doesn't, it means tighter risk control. Let's start with Forex. Choose a major pair like USD or GBP/USD. Major pairs have tighter spreads and better liquidity. That alone reduces hidden costs. Now this is important. Don't focus on leverage first. Focus on position size. Your lot size determines your exposure. If you don't understand how much you are risking per pip, you are gambling, not trading. Here's a simple rule that protects you long term. Never risk more than 1 to 3% of your account on a single trade. That means you calculate your stop loss first, then adjust your lot size accordingly, not the other way around. Most beginners open a position first and think about risk later. That's backwards. And here's something most YouTube videos won't tell you. Even a strategy with 50% win rate can be profitable if your risk-to-reward ratio is controlled. That's where Forex shines. It moves in trends and ranges that respect structure more often than random meme coins. But don't relax yet because gold trading works slightly differently. How to trade gold the smart way? Gold, or XAUUSD, behaves differently from crypto. It reacts strongly to macro events, inflation data, interest rates, and geopolitical tension. That means it respects key levels and psychological zones. Many traders are scared of gold because they think it requires huge capital. That's not true. On Bitget TradFi, you can open small positions with manageable margin. The key is understanding that lot size represents contract exposure, not necessarily the amount you must fully own. Here's where traders lose money with gold. They overtrade during high volatility news hours. Instead, Wait for structure. Wait for confirmation. Let the market show its hand first. Trading is not about predicting. It's about reacting with discipline. Now pay attention to this part because it's crucial. The difference between a trader who survives and one who burns out is not the indicator. It's risk management. If you use leverage responsibly, set stop loss before entry, and limit your exposure, you automatically eliminate catastrophic losses. And eliminating catastrophic losses is more important than chasing big wins. Risk management framework that changes everything. Let me give you a simple framework. Imagine you take 20 trades. If you risk 2% per trade, the worst possible drawdown from consecutive losses is survivable. But if you risk 10% per trade, 5 bad trades can destroy you. Most traders don't fail because their strategy is bad. They fail because their position sizing is irrational, and here's the paradox. When you reduce risk, your consistency increases. When consistency increases, your confidence stabilizes. When confidence stabilizes, you stop revenge trading. That psychological shift alone can double your long-term survival rate. And if you decide to test this system yourself, remember to use the registration link in the description and referral code. Rebate 20 so you activate the 20% fee rebate and unlock the trading bonus. Lower fees and better capital efficiency give you a mathematical edge over time. And in trading, small edges compound. Entry structure: how I actually take trades. Now let's talk about execution. Because knowledge without structure leads to hesitation. And hesitation leads to missed opportunities or emotional entries. My approach is simple. First, I identify higher timeframe structure. I look for clear support and resistance zones where price has reacted multiple times, not random lines. Real reaction zones. Second, I wait for price to approach that zone. I do not chase in the middle. This alone eliminates a huge amount of bad trades. Third, I drop to a lower time frame and look for confirmation. That can be a rejection candle, a break and retest, or momentum divergence. I am not predicting direction. I am waiting for the market to reveal intention. Here's the micro detail most beginners skip. Your stop loss should sit where your trade idea is invalidated, not where it feels safe. If price breaks structure convincingly, your idea is wrong. Accept it quickly. Small losses are business expenses. Large losses are ego. And here's the curiosity most people never test. What happens if you only take trades at key zones and ignore everything else for 1 month? Most traders overtrade because they confuse activity with productivity. But high-quality setups often appear less frequently than you think. When you reduce frequency and increase selectivity, your win consistency improves. Building a simple gold strategy. With gold, I focus heavily on session timing. The London and New York sessions provide the cleanest moves. During low liquidity hours, spreads widen and fake breakouts increase, so timing matters. I mark the previous day's high and low. I watch how price reacts near those areas. If gold sweeps liquidity above a previous high and quickly rejects, that often creates a high probability reversal zone. But again, confirmation matters. Never enter blindly. Now here's something powerful. Combine structure with macro awareness. If inflation expectations rise, gold often reacts. If the dollar strengthens aggressively, gold may face pressure. You don't need to become a macroeconomist, just understand the relationship. Structure plus context equals edge. And let me pause here for a second. If you're serious about applying this framework, make sure you've set up your Bitget TradFi account properly using the link below and referral code rebate20. The 20% fee rebate on futures and spot trading reduces your cost per trade over time. Most traders ignore fees, but fees compound just like profits do. Lower friction equals higher survivability. The psychology shift that changes your results. Now I want to address something deeper. Trading Forex and gold instead of only crypto changes your psychological environment. Crypto often rewards impulsiveness in short bursts. Forex and gold reward patience. When the market moves slower and more structurally, your decision-making improves. And improved decision-making increases perceived control. Perceived control is powerful. When you feel in control, you stop reacting emotionally. When you stop reacting emotionally, you stop breaking your rules. And when you stop breaking your rules, your equity curve stabilizes. This is not about hype. This is about sustainability. Let me ask you something. What if your goal was not to double your account this month, but to survive and grow steadily for the next year? That single mindset shift filters out 80% of destructive behavior. Trading becomes boring. And boring is profitable. Common mistakes to avoid. Do not over-leverage just because the option exists. High leverage is a tool, not a requirement. Do not move your stop-loss further just to avoid being wrong. That is how small losses become disasters. Do not increase position size after one win out of excitement. Consistency beats aggression. And here's the hidden mistake: switching strategies every week. If you don't give a structured approach enough sample size, you never discover its real expectancy. 20 to 50 trades under one rule set will teach you more than jumping between 5 indicators. How to scale responsibly. Once you achieve consistency with small capital, scaling becomes logical. Increase position size gradually while maintaining the same risk percentage. Never scale risk emotionally, scale it mathematically. If your system produces stable results, your capital growth should feel controlled, not explosive. Remember, professional trading is not about adrenaline. It's about edge multiplied by discipline over time. So here's the big picture. Crypto gives you speed. Forex and gold give you structure. Bitget TradFi gives you access to both within one ecosystem using USDA margin. If you've been frustrated with volatility destroying your discipline, this may be the strategic shift you needed. If you're ready to test this yourself, use the registration link in the description and enter referral code REBATE20 to activate your 20% trading fee rebate and unlock the welcome bonus up to $6,200. If you're going to trade anyway, you might as well start with reduced fees and additional capital efficiency. In the next video, I'll break down a full live trade example from entry to exit and show you exactly how I calculate position size before clicking the button. Because at the end of the day, the goal is not to trade more. The goal is to trade smarter. And that shift alone can change everything.